Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about our market outlook and what happened within diversified funds last month. So starting with the outlook, looking at the US stock market and the economy, we can see that these Mag 7 stocks are still leading the way. We've discussed that narrow leadership of those 7 names over the last couple of updates, but that still seems to be the case. It's not that other stocks haven't risen, but they just haven't risen enough to match what has happened within that concentrated group. Well, the question now is what happens next and whether we would see some broadening of that market rally. I think there are a couple of things that should support that broadening of the market. One thing is that we still haven't seen Fed cutting rates. We had some cuts last year, but since then Fed has been on hold and the markets have actually rallied quite strongly despite not having a support from the Fed. Historically, when Fed started to cut rates again, markets did broaden up. So we'll hopefully see broader market participation. Now, the other thing which is really encouraging at this point is that US inflation here on the right-hand side is trending down. So if we did see any weakness in the growth coming to the second half of the year, the Fed should be in a position to support the economy. Now, we obviously have gone through a very volatile period in the first half of the year. Markets corrected almost 20% in the beginning of April, following Trump's Deliberation Day, and then markets now fully recovered, almost fully recovered to where we started. Now here on the left-hand side, we are showing you the trade policy uncertainty index. And as you can see, there is a very strong relation between that index and S&P 500. The point is that when trade policy uncertainty increases, markets correct, but then recovery often starts when that turns. And we believe that going into the second half of this year, we should actually see some of those policy risk subsiding. Now, in the meantime, we had tariffs coming into place, and as we speak, Trump is announcing some of the tariffs for different countries, and we had reciprocal tariffs just moved by a couple of months again. But the main point here on the right-hand side is that even though the average tariff has increased quite substantially to almost 12%, household consumer expenditures continue to be strong. And also, on the corporate side, S&P 500 profit margins have actually reaccelerated and are expanding again. Now, the question is what happens next, and we obviously don't have the answer to this, but here is just looking at a chart showing past interest rate cycles and when the cuts happened. Here on the left-hand side, you can see basically S&P 500 performance from the dotted line when Fed was on hold for 6 or more months. And if we have no recession, which is our base case, earnings growth is expected to continue. So historically, as you can see, markets have done well in the scenario where there was no recession. And here on the right-hand side, again, what we think is going to happen at least until the end of the year, if we have no recession, we would not expect multiples to expand. But if earnings grow, that should provide a strong support for stocks in the US, but also globally. I'll just pass on to Ryan now.
Thanks, Marek. So I'll quickly take you through some updates around the domestic economy in New Zealand. So in the month of June, we had the Q2 QSBO, so the quarterly survey for businesses in New Zealand. And I guess just a few things to highlight here, particularly that would worry the RBNZ, and they are the price hike intentions on the left-hand side, and that's plotted against CPI. So if we have a quick look at that, we can see that the businesses surveyed within the QSBO, their forward intention, so this chart is indexed 2 quarters forward. You can see that it's quite closely correlated with CPI, so headline consumer price index. And given the current trend of the people's price hike intentions, we can see that that's going to provide some deflationary pressure to CPI as businesses don't plan to actually hike prices. So why would the RBNZ care? Because it looks like, again, if you just extrapolate the trend on the yellow line, that CPI might undershoot the target band of 1 to 3% for RBNZ's CPI target. Now looking to the right-hand side, we have sales as a major factor constraint to activity. And all we wanted to highlight here was that this effectively tells the readers of the survey what is holding businesses back from increase in own activity. And when sales becomes the dominant factor in holding businesses back, we can see that in each point where it rises above, say, roughly 70% here, it tends to be a recessionary condition. Or the New Zealand economy is in a recession. Now, obviously, RBNZ has cut quite significantly since their previous high in the cycle of 5.5%. So this would be some sobering viewing for them, as it may imply that they need further monetary policy relief to get the economy going in terms of growth. Turning now to the individual diversified funds for the month of June, we have the Diversified Income Fund first. So performance was plus 1.1% for the month, and asset class performance was broadly positive in June as markets seemed to breeze past the geopolitical events in the Middle East during the month. So Australasian equities was our top contributor, plus 0.5%, with fixed income the next positive contributor, plus 0.4%, and then finally global equities coming in at plus 0.3%. Turning to the positive contributors of the performance, within global equities we have Broadcom up 13.9% and Oracle Corporation up 32.1%. Broadcom actually announced a strong Q2 earnings report at the start of June, with the gross margin surprising to the upside. Within Australasian equities, we had SRG Global up 14.6% and Scales Corporation up 7.4%, and they're the top 2 contributors in June. SRG Global continued a strong form from May and into June, and they bumped this month after being awarded over 850 million Aussie dollars worth of contracts across multiple sectors during the month. Within fixed income, we had a small rally in rates led mostly by offshore, with the biggest one-day move coming when the US GDP estimate came out during the month, and that came in well below expectations at negative 0.5% for Q2. And then that had a spillover effect for our domestic yield curves, with yields falling, led by the 2 to 3 year point in the curve. The 2-year swap was down 11 bips over the whole month of June. Turning to look at negative contributors, within global equities with Unilever PLC down 7.6% and LVMH down 7%. They're the 2 main detractors from performance. Unilever actually dropped as news emerged that they were considering selling their Graze food unit, which they had recently acquired in February 2019. Within domestic equities, we had Telex Pharmaceuticals down 6.4%, and that was the worst performer for the month. And then markets reacted negatively to their lack of an upgrade to guidance at their recent investor day, and this coupled with continued uncertainty in the US with respect to public spending on Medicare and it being cut. Turning to the growth fund, so again, asset class was performance in June for the growth fund as well. So it was up 2.1% for the month. Global equities was the top contributor, plus 1.6%. Australasian equities was next, plus 0.5%. And then finally, fixed income was also positive at plus 0.1%. And again, turning to the positive contributors, we had Oracle Corp within global equities up 32.1% and Netflix up 10.9%. So Oracle Corp surged again in June after a strong previous month in May. And that was driven by strong Q4 earnings, with cloud services support being a particular highlight for the business. Within Australasian equities, again, we had SRG Global and Scales Corp up 14.6% and 7.4% respectively. And Scales updated the market with financial year 25 guidance, with higher earnings than expected coming from their horticulture business division. And again, within fixed income, we had that small rally in rates led by the offshore. Turning to negative contributors for the growth fund, Within global equities, again, we had Unilever down 7.6 and LVMH down 7. LVMH actually struggled as concerns in the luxury goods sector continued, and then with the perceived reprieve on tariffs not forthcoming from the US, as negotiations from some countries appeared to stall. And then finally, again, within domestic equities, we had Telex, and that was down again after their lack of an upgrade to guidance and from their investor day in June. And that's all from me.
Right. Thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.